residential status. Residential status of Amir Rusydi based on Section 7 of the Malaysian Income Tax Act 1967. The residential status is determined by the number of days the taxpayer physically present in Malaysia and whether the conditions under Section 7 are fulfilled. For the year of assessment 2022, Amir Rusydi stayed in Malaysia during 3 periods, which is from 3 February to 24 March for 49 days, from 6 April to 6 July for 91 days, from 11 December to 28 December for 11 days. The total number of days in Malaysia was 157 days, which is less than 182 days. Therefore, the taxpayer is classified as a non-resident for the year of assessment 2022. For the year of assessment 2023, Amir Rusydi stayed in Malaysia from 10 January to 5 July for 176 days. Although the stay was less than 182 days, the taxpayer qualified as a resident under Section 7, Subsection 1, Subsection B. Because this period is linked to another qualified periods, the temporary absence was due to accompanying his mother for her surgery, which is considered an elaborate temporary absence. For the year of assessment 2024, Amir Rusydi stayed in Malaysia from 10 April to 11 October for 184 days. Since the taxpayer was physically present in Malaysia for more than 182 days, he satisfied the requirement under Section 7, Subsection 1, Subsection A. For the year of assessment 2035, Amir Rusydi stayed in Malaysia during 2 periods, which is from 1 January to 27 March for 85 days and from 31 July to 27 October for 88 days. The total number of days in Malaysia was 173 days, which is less than 182 days. Since Amir Rusydi does not satisfy the condition under Section 7, he is classified as non-resident for the year of assessment 2025.
Next, I will be presenting the statutory of employment income of Amir Rusydi for the year of assessment 2025. First, we calculate the gross employment income, which consists of employment benefits under Section 13 of the Income Tax Act. Under Section 13, Subsection 1A, we include all cash remuneration received by the employee. This consists of the annual salary of RM144,000, travelling allowance, entertainment allowance, individual membership fees, reimbursement of laundry expenses, and gain from the share option scheme. However, the first RM6,000 of the travelling allowance is exempt from tax, while the food allowance and reimbursement for the work-related costs in Melaka are fully exempt. Therefore, the total employment income under Section 13, Subsection 1A is RM191,800. Next, under Section 13, Subsection 1B, we include benefits in kind provided by the employer. These include the company car, petrol, fully furnished accommodation, and leave passage to Tunisia. The medical treatment benefit is fully exempt from tax, and for the overseas leave passage, only the amount exceeding the exemption is taxable. Hence, the total benefits under this section amount to RM35,030. Moving on to Section 13, Subsection 1C, this covers the living accommodation benefit. The taxable value is determined using the lower of the defined value or 30% of employment income under Section 13, Subsection 1A. In this case, the defined value of the house is lower, resulting in RM33,000 after adjusting for 11 months of occupation. In addition, hotel accommodation for 1 month is calculated at 3% of Section 13, Subsection 1A, giving RM480. Therefore, the total living accommodation benefit is RM33,480. After combining all these components, the gross employment income is RM250,310. We then deduct allowable expenses incurred in the performance of employment duties, namely rental of RM11,000, entertainment expenses of RM18,000, and travelling expenses of RM24,000, giving a total deduction of RM53,000. Finally, after deducting these allowable expenses from the gross employment income, Amir Rusydi's statutory employment income for the year of assessment 2025 is RM197,310.
Now I will present the statutory business income computation for Aura Venture Services for the year of assessment 2025. We begin with the company's net accounting profit before taxation, which stands at RM234,700. And to find the two taxable business income, we must adjust this figure according to Malaysian tax law. First, we deduct non-business income that is taxable under a separate section. This includes RM34,500 in interest income and RM28,000 in rental income. Next, we look at business income not yet added. The insurance claims received for flood damage to office furniture, computer and network equipment total RM62,000, which are added here as taxable business recoveries. Moving on to non-allowable expenses, we must add back items that are not tax deductible. This includes RM38,000 for depreciation and RM46,000 for office renovation, as these are capital in nature. And for remuneration, the employee's EPF contribution exceeded the 19% statutory limit, requiring an add back of RM5,250. And under entertainment, the RM3,100 for event decoration and AV is added back. We also add back the RM21,000 donation to an approved institution, and it is dealt with at a later stage, and the RM36,500 legal fees bill. And next, we apply incentive via double deduction. We subtract RM24,000 for the structure internship program and RM31,000 for the international trade fair expenses. And after offsetting our total deduction of RM235,000 against our total addition of RM446,550, we arrive at an adjusted business income of RM211,550. Finally, to compute the statutory business income, we add a balancing charge of RM50,000 and subtract capital allowance totaling RM61,000. And this leaves our venture services with a final statutory business income of RM165,550 for year assessment 2015.
As a brief background from our partnership agreement documents, our firm underwent a significant structural change this year when our partners, Mr. Anwar Majid, voluntarily withdraw from the business, effective on the 30th of September 2025. Because of this, we have two distinct the periods that we must account. First, for the 9-month period with 3 partners and the 3 months period with just 2 remaining partners. Let's look at the first image to find our starting point, which is the provision adjusted income. We begin with the reported accounting net profit of RM50,000. Since partner personnel expenses and internal business payment are not tax deductible, we must add them back as non-allowable expenses. This includes RM7,000 for donation, RM15,000 for depreciation, and lastly, the partner salary, which total RM135,000, and their personal drawing, which total RM24,000. When we add all of this value back to our original net profit, we get a total provision adjusted income of RM231,000, calculating divisible income and time allocation. Moving on to the second image, we need to determine the visible income before we can allocate it to each partner. We'll calculate this by taking our provision adjusted income of RM231,000 and subtracting the partner's private expenses, specifically the salary and drawing that we add back earlier. This leaves us with a divisible income of RM72,000. Due to a retirement in the middle of the year, this RM72,000 must be split chronologically based on time. First, the January to September period, which covers 9 months. The calculation is RM72,000 multiplied with 9/12, which gives us RM540,000. It gives us RM54,000. According to the original agreement, profit sharing is equal for this period, resulting in RM80,000 each for Amin, Yazid and Anwar. Second, the October to December period, which covers the remaining 3 months, RM72,000 multiplied by 3/12 gives us RM18,000. According to the new partnership agreement, this remaining profit is split based on ratio of 60% and 40%. This gives Amin RM10,800, Yazid RM7,200, and Anwar receives nothing since he has already withdrawn. Finally, partner allocation and statutory income. Finally, let us refer to the first schedule in the third image to determine the final statutory income for each partner. To find the individual adjusted income, we combine each partner's chronological share of divisible income with their specific salaries and drawing. The first one, Amin Rusydi, achieved an adjusted income of RM88,800, while Yazid Muhammad reached RM81,800, and Anwar Majid finished with taxable income of RM64,000. The final step is to apply the tax adjustment mentioned in the firm's internal memo, which are the capital allowance and the balancing charge. The balancing charge of RM3,000 is added, while the capital allowance of RM7,000 is deducted. As shown in the schedule, these tax adjustments are shared equally only between the partners who are still active at the end of the basis period, meaning Amin and Yazid. They each get an additional balancing charge of RM1,500 and a capital allowance deduction of RM3,500. After taking this final adjustment into account, we arrive at our final statutory income figures for the year of assessment 2025. For Amin Rusydi, we get 84,800 ringgit, while Yazid Muhammad item total of 77,800 ringgit, and lastly Anwar Majid 64,000 ringgit. This we can conclude our calculation and allocation process with successful complies with both our changing partnership terms and standard tax regulation.
Next, industrial building. First, we identify the qualifying building expenditure QBE for the factory building. The qualifying costs are architect fees, cost of preparing plants, construction cost of the factory warehouse, and installation of water and electricity. The cost of land is not qualifying, while the cost of preparing the site for machinery and the heavy machinery are treated separately under 75% rule. Therefore, the total qualifying building expenditure is 505,000. Since only 80% of the building is used as a factory, the QBE is 404,000. Next, we calculate the industrial building allowance. The initial allowance, which is 10% of 404,000, is 40,400. The annual allowance, which is 3% of 404,000, is 12,120. Therefore, the total industrial building allowance for YA 2025 is 351,480. Next is the 75% rules for the heavy machinery. The cost of preparing the site to install the machinery is 300,000, and the heavy machinery costs are 50,000, giving an aggregate cost of 350,000. Under 75% rules, cost of the preparing the site is 300,000 is more than 75% rules, which is 245,000. Heavy machine and cost of preparing the site can be included as QBE, so QBE is 350,000. For YA 2035, the initial allowance is 10%, which is 35,000. The annual allowance is 8%, which is 28,000. Therefore, the residual expenditure is 287,000. Finally, there is no balancing charge because the factory building and heavy machinery were not disposed of during YA 2025.
Today, I'm going to present the income tax liability for Mr. Amin Rusydi for the year of assessment 2025. First, let's talk about where Mr. Amin gets his money. He has a few different sources of income. From his business, he runs a sole proprietorship called Aura Venture Services. After adding the balancing charge and subtracting capital allowance, his business income is 165,550. He also has a partnership business that gives him 84,800. So his total business income is 250,350. From his job, his employment income is 250,310. After we deduct his work expenses like travel, entertainment, and grant, his net employment income is 197,310. From other sources, he also earns 12,710 from renting out property and 5,500 from digital book royalties. When we add all of this together, his aggregate income is 465,870. Mr. Amin kindly donated 20,000 to a school library, which reduces his total income to 445,870. Next, the government can reduce this total income by using tax relief. Mr. Amin can claim a lot of reliefs. He gets the standard 9,000 personal relief. He claims medical expenses for himself and his grandparents, which total 5,500. For his lifestyle, like internet bills, a gym membership, and sports equipment, he claims 4,400. He also claims 7,000 for his housing loan interest, 2,500 for an electric vehicle charging wall, and 7,000 for insurance and EPF savings. Finally, because he is a father, he gets 20,000 total relief for his 4 children, Qaid, Haras, Faika, and Sofia. In total, his tax relief add up to 55,400. If we take his total income and minus this relief, we get his chargeable income, which is 390,470. This is the final amount that will actually be taxed. Now, for calculating the tax, since his chargeable income is 390,470, we use the Malaysian progressive tax brackets. For the first 250,000, the tax is a fixed 46,900. For the remaining 140,470, it is taxed at 26% rate, which equals 36,522. Adding those two together, his initial income tax liability is 83,422. However, Mr. Amin paid 25,000 zakat. In Malaysia, zakat acts as a direct rebate, which means we can minus it directly from the tax bill. So after minus the zakat, Mr. Amin Rusydi's net income tax liability for 2025 is 58,422. This is all from me, and I end our presentation with thank you.